But this is a lesson I would like to draw attention to. Those other directors who are being invited by shareholders to represent them on the boards of listed companies. That once a director is appointed to a board and elected during the subsequent AGM, he stops being a representative of the shareholder who nominated him. He becomes an agent of the company on which he is sitting on the board. It doesn't matter the views of the shareholder who nominated him. His interest is to safeguard the interests of the company, of the various stakeholders who do business with that company, not with the shareholder. If you looked at the board of CMC, you'll see one or two other directors who, in spite of their experience in other company boards, were shy to comment on things happening there because they were friends of key shareholders who would not have liked them to comment on things like, directors doing business with their company. Once again, a very sad affair. And what we will be doing going forward is to ensure that directors who are nominated to sit on the boards of listed companies must, if of necessity, first of all, have some evidence that they have gone through a corporate governance course, 1 week, and they don't take long. Because within that course, directors and participants were introduced to the roles of directors, the roles of boards, the roles of CEO, the roles of the chairman, the relationship between the boards and shareholders. So that once you become a director of a listed company, you know that you represent the interest of that company, not outsiders, not the shareholders who put you there. Again, when we think of the role of the CEO, once again, and the role and the position that Martin Foster held within CMA, or with the CMC, we would like to draw attention and warn other CEOs in the market that this continued of dominance, pretending that you know everything, you cannot use your board to effect the policies that your board has formulated, time is up. You have to work with your board. As I said, in addition to making sure that all directors produce evidence of corporate governance, courses and knowledge about what is happening, we would also wish to see directors of listed companies knowing the time to leave. It's a violence picked from politicians. You see somebody in their 80s, they still want to be MPs. They still want to be members of parliament when they could allow their sons, their younger generation to take over. I know the New Companies Act is going to have some regulations around this, but from CMA's angle, what we would like to see is at least directors who are over 75 years will not be allowed to sit on boards of listed companies. And with a reason. Reason being that sometimes you are requested to go through very technical board papers. You have to know the financial ratios to be able to follow what is being presented at a board meeting. By the time you're hitting 75, it's better that you allow your son who is in their 40s or 50s or 60s or others in that range to come on board. We'll be scrutinizing the special resolutions that allow boards to continue engaging directors over 72 years, which is the provision for the Companies Act, and tell them, no, after 75, we will not entertain directors being appointed on boards of listed companies. And you guys, you agree with me. It's in fairness. It's for the interest of the companies concerned. We are also going to follow the guidelines from our new constitution to ensure gender consideration. In most of the boards I have been involved with, I find some of the ladies, most of the lady directors on those boards, being much more attentive. And I'm serious about this. So I would like to see at least a fair number of ladies being appointed to boards of listed companies. Now, those ladies could be part of the independent directors that we have been pushing a case for, or in their own right. And we have very qualified ladies, I can assure you, who perform much better than their male counterparts. We would like to have a fairly good degree of the Kenyan fish on the boards of listed companies. Let's be fair. Kenyans buy shares in listed companies from all quarters of the country. So let's try to be saying that at least we have given consideration to geographical consideration when appointing directors to the board. There are one or two companies, and they're listed. You count the number of directors, you count those who come from the same county or the region, and you see more than half of that. We would like to avoid a situation where board matters could be discussed in local vernacular. So let's open up. We are all Kenyans. In addition to gender, geographical considerations. Realize that we are determined to bring more products and encourage others to bring products so we can deepen the capital market. This is where we are going. We want to look at the counties, see the opportunities there. We want to do more of development, not chasing the naughty guys who have misbehaved. But we have to do that because we have to install confidence in the marketplace. I really wanted to emphasize this note so that those outsiders who want to use an escape route that, oh, CMA is doing nothing else but overregulating the market. We are not overregulating the market. We are trying to make sure that investors, both local and foreign, have confidence in our market. Because unless we do that, all these nice products we are introducing in the market, the growth enterprise market segment, the leads, commodities, we'll soon be coming up with the commodities exchange. We want to go to the counties and, as I mentioned the other day, help them to form development and investment agencies on the county level so that those agencies could issue bonds for instance. Just imagine 47 counties. If at least half of those who are going to be lucky to have governors with strategic thinking for their counties, just imagine, is 25 counties formed investment agencies, which then issued bonds for developmental projects in their respective counties. Let's say $1 billion worth of bonds. We're talking about 35 billion shillings raised on the capital market. this is where we are going. This is where we would like to go. If we were to come to banks, we would not like to step on the toes of the central bank because they are the regulators, but we have these overlapping powers as CMA and the central bank when they give their guidelines on how banks should behave. We are also there to make sure the directors behave within the corporate governance structures. So we have these overlapping powers. And the message is, as we regulate those listed companies, the licenses, the one we license ourselves, there are also those in the capital market that, although licensed by other regulators, we do have overlapping powers, and we will make use of it. I said I'm not going to detail figures and numbers because they are already in the press release, and I'll allow you to go and read them. And if you have any questions, I'll be prepared to answer one or two.